Algorithmic trading models designed for equities and futures often shatter when deployed in the options market. The core architecture of a traditional trading algorithm relies on linear forecasting. The system executes trades based on expected future price direction. Options immediately break this model. Their profitability is multidimensional. Variables like time decay and volatility warp the option's value entirely independent of the underlying asset's price. A standard technical indicator, like a moving average, is mathematically insufficient here. A buy signal based purely on price momentum is useless for an asset with a fixed lifespan that bleeds value every day it is held. To automate options trading effectively, developers have to discard directional forecasting algorithms entirely and engineer their systems from the ground up to target a completely different metric. If the system isn't designed to predict price direction, what exactly is it calculating? The fair value of an option represents a quantified estimation of future uncertainty. Higher perceived uncertainty leads to higher market pricing for the derivative. A robust options algorithm evaluates the mathematical divergence between the uncertainty estimated by the system and the uncertainty implied by the market price. The algorithm calculates a numerical value for its modeled uncertainty, aligns it with the market's implied value, and isolates the difference. As the research notes, criteria based on the interrelationship between two uncertainties evaluate the fairness of the option market price. Within the system architecture, this divergence metric functions as the criterion for evaluating the fairness of an option's price, providing the data necessary to trigger automated signals. By targeting structural uncertainty mispricing rather than guessing directional price movements, the algorithm secures a reliable, quantifiable edge in a highly nonlinear environment. Identifying mispriced uncertainty works well in theory, but it fails if the system remains exposed to severe directional swings in the underlying market. The strategy requires a structural chassis of market neutrality. The goal is to insulate the portfolio's overall value from both small fluctuations and large spikes. The primary tool the algorithm uses is delta. Maintaining delta neutrality on a single position is highly inefficient, creating unmanageable transaction costs. Therefore, the system manages positions across a multi-asset portfolio, continuously structuring it so the sum of all component deltas equals zero. Due to the nonlinear nature of options, this aggregate profile cannot be determined by simple linear addition. To successfully maintain this delicate equilibrium, the system requires a continuous, computationally intense process of dynamic, long-term portfolio management. Aggregate delta neutrality acts as a mathematical shield. It safely houses the uncertainty divergence engine, allowing the strategy to extract value free from the noise of market direction. Coding this theoretical architecture into functional software introduces a distinct set of engineering challenges. Developers typically fall into one of two methodological traps when building their algorithms. The first is the pure scientific approach. Here, a system is built entirely on rigid economic rules and fundamental estimates, completely rejecting optimization procedures. While logically sound, this theoretical approach usually fails in live markets. It lacks the flexibility required to adapt to the microstructural nuances of actual trading environments. The alternative is the empirical approach. This is unguided data mining. The developer relies entirely on machine learning and genetic algorithms to search for trading rules that maximize simulated profit, ignoring economic logic entirely. This chart illustrates the fatal flaw of the empirical approach, catastrophic overfitting. Given too many degrees of freedom, the algorithm curve fits itself to historical noise. It creates a perfect historical record, but upon encountering live, out-of-sample data, the strategy collapses. A system built on pure theory will break under market friction, and one built on historical data will simply lie. A robust system requires a hybrid framework. As outlined in this text, combining scientific methods and empirical approaches creates the rational approach. It is the necessary engineering standard for automated options development. First, the developer establishes unyielding structural boundaries based on foundational market mechanics, defining the asset universe and non-negotiable risk limits. Second, empirical optimization is introduced, but strictly contained within this scientific perimeter. These rigid boundaries prevent the excessive degrees of freedom that cause overfitting. The rational framework harnesses the self-learning power of modern computing while protecting against data mining biases.
Automating options trading is a distinct engineering discipline, operating on rules alien to standard algorithmic trading. The first pillar rejects linear forecasting, strictly trading pricing uncertainty divergence. The second pillar applies portfolio-level delta-neutral logic, slicing through market noise to isolate the edge. The third pillar utilizes the rational framework to police the boundary between economic logic and machine optimization. When these structural elements are integrated into a software pipeline, the system achieves true market independence. As we have finally established, true algorithmic alpha in nonlinear derivative markets originates from the rigorous mathematical constraint of uncertainty.